Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and today I'm giving you a market update for March 2024. So, before we get into some data and some graphs to show you where we sit in the market, I use the 18-year land cycle as a framework to best understand where we sit at a macro level, and then I overlay that across different markets to understand where we are potentially heading in the coming years. I then use sources of data to refine and further clarify and to confirm that we are on track based off the 18-year land cycle. The 18-year land cycle is a cycle that consists of 14 years of expansion and 4 years of downturn, with a mid-cycle slowdown in the middle and a larger land-driven downturn towards the end of the cycle. The 18-year land cycle is an average 18 years. It has been happening since the 1800s. The cycles have never been less than 17 years and never longer than 21, and on average 18 years. So depending on policymakers, who's in government, who's making the calls at a government level, will depend on if the cycle performs longer or shorter. I'll give my um, thoughts around where we are currently heading. So based on history, we are on the yellow marker, similar to 2004. So coming out of the um, mid-cycle slowdown after the dot-com bust in 2000, and then there was a recovery, and then there was a good strong bull run between 2002 up to 2007, prior to the GFC, which was the last land-driven downturn. We then recovered, so the current cycle started in 2012. We had a strong run from 2012 up to 2019. Sydney and Melbourne outperformed, typically and historically, in the first half of the cycle. They have now then plateaued, and then because they get so high, the prices of the property become so unaffordable. People then start decentralizing into more affordable markets, such as Brisbane, Perth, and Adelaide. That's when those supplementary markets then outperform in the second half of the cycle, which they are now, which I'll show you in coming slides. So we had COVID, which is also a mid-cycle slowdown between early 20 or late 2019, early 2020, and then a slowdown into 2022. Um, we are now well away at the races in 2024, and in the lead up to the market peaking in 2026. So based on history, if, for example, um, Joe Biden wins the election, or someone else in his party wins the election, the market will most likely run its course 17, 18 years and top out in 2026. If Donald Trump gets in, as an example, he's got vested interest in property. He'll do everything in his power to keep the economy pumping and moving along while he's in power. So he will cut taxes, cut lending regulations, apply tariffs, all of which is aimed to boost the economy and boost the property market, the largest in the world. If that happens, if he comes in November, in back end of 2024, he'll most likely push the market towards a more of a 19, 20, 21 year cycle, and he'll kick the can down the road, even push it harder. So the peak of the market could be even further than 2026. So it could run to 27, 28 even, which I think if he comes in, I think the market will get pushed bigger and higher, and every boom dwarfs the boom before, and every land-driven downturn bust will be larger than the one before. So the setup will be even greater and bigger um, than the lead up prior to the GFC, and the GFC crash, um, the coming land-driven downturn in post 2028 will be the biggest in history because there's more credit, there's more debt, prices are higher, they can fall, boom higher and bust um, lower. So to give you some more context of how I see the market really playing out in the next few years, March we have really seen the national dwelling values. This is core logic data really starting to bed down into a sustainable upturn. So we've had now 13 or 14 consecutive months of price gains, 10.2% nationally. So well and truly recovered the slowdown from the mid-cycle slowdown of 7.5%. And we also have um, this is now based on a state-based and a metro market base. So we've got Brisbane, Perth, and Adelaide leading the charge. As you can see, Sydney and Melbourne are pretty much flatlining because they've topped out in terms of values. People are now decentralizing. As I said before, this is now why we are seeing Brisbane, Perth, and Adelaide because they're more affordable markets. The prices of property are coming off a lower base. They're now booming like um, history shows in the second half of the cycle, and their respective states, regions as well. So Queensland, regional South Australia, and regional WA, with New South Wales and Victoria um, pretty much flatlining because they've topped out in terms of values for the time being. I would say they will keep running until so Brisbane, Perth, Adelaide will keep running to the peak of the market, and then from around 2025, 26, I'm going to start then looking to start deploying capital and buying more property in Sydney and Melbourne and regional New South Wales and regional Victoria to get ahead of the curve. Um, you want to buy when it's soft markets because you can get property for underbanked value, allows you to draw your equity out and recycle it and keep building your portfolio. So there's still good opportunities now in Brisbane, Perth, Adelaide. Personally, if you come on with my buyer's agent services, we are only focusing on Brisbane and Queensland regions. We are not looking at Perth and Adelaide. I think they're well and truly too hot, and that ship has sailed. But there's still good value in Brisbane and regional Queensland. And then probably I'd say the back end of this year and early 2025, I'm going to then start focusing on Sydney and Melbourne because the prices will get so hot and too expensive. You don't want to get caught at the peak of the market because people who keep plowing into Brisbane, Perth, and Adelaide towards the peak of the market will be holding it for 10 plus years in the first half of the next cycle before they see any substantial growth. So there's still a good few years, probably I'd say max 2 years to keep focusing on Brisbane, and then um, once we get into 2025, I'm going to be well and truly just focusing on Melbourne and Victoria and Sydney and New South Wales because most people will be ploughing into those markets, Brisbane, Perth, Adelaide, and overpaying, and I want to focus on areas that are yet to go through their next upturn. Back to the monthly chart. So how I see the market continually rising is the net overseas migration rate is the on record the highest ever, 700,000 wealthy migrants. These are people with degrees, jobs, with cash savings of more than 250,000, even up to $1 million in the bank. This is federal government policy that um, they require for them to come. So that ultimately, when they have good, strong paying jobs, good savings, when they come to Australia, they need housing. They're going to prop up the economy and keep driving the property market to the next level. Historically, the net overseas migration rate is between 150 to 200,000. And then in the first half of the cycle, or pre-COVID, decade average was around that 400 mark. Now it's 6 to 700,000. So it's well and truly hitting all-time new levels. So Australian government also have targets to hit 40 million population by 2040, which is crazy to really see those targets, because ultimately the infrastructure and the supply of housing will never keep up with that demand. Therefore, prices will continue to keep rising very rapidly. Classic supply and demand. So this is the monthly dwelling approvals rate. So this is developers lodging development applications to build either house and land or high-rise residential apartments or any new development. It is at the record, not record low, but it's the lowest seen in over 13 years. So since 2011, 2012. And the reason for that is because the price of materials and labor is so high, it's not making new developments stack up. So by the time a developer goes and builds a block of 50, 100 units, the cost of building each of those units is around that 600,000 mark, or building a house. By the time you buy the land, build a house, you're in it for $1 million. By the most of the sites across Australia are not worth that. So it's not worth just building for the sake of building if there's no profit in those jobs. So that's why there's a very low development application rate, as builders and developers are still waiting on the sidelines until prices rise considerably, at least 50% plus, to then allow the projects to then stack up and be profitable. And then that's when there will be an uptick in development applications, which will then flow through to actual new development and construction being supplied. So this is a good leading indicator to show when supply is coming, and it's many years away. So with net overseas migration continually ploughing in at record numbers and the lowest development applications seen in over a decade, classic supply and demand, massive demand from people coming to work and live in Australia, beautiful place to live, and we are not building enough housing to house these people. So prices are going to keep booming. Another thing, so that was CoreLogic data. Another piece of data I like to keep an eye on is the medium rents. So this is just a snapshot of units. This is Dr. Andrew J. Wilson. I suggest following him. He is a non-mainstream economist. Um, I really, uh, I really value his work. I'm not promoting him by any means, but he really cuts through the noise of the media, and really, it really resonates with me, as I can overlay what he says and his data that he sees over the 18-year land cycle. So his data that he has collected shows that rents in the last month and this year for Sydney, Melbourne, Brisbane, Adelaide, and Perth are all rising considerably. So Sydney 10.7%, Melbourne 17.5%, Brisbane 16.2% increase, Adelaide 11.2, Perth 14.9 just this year. So when rents rise, the earnings of the property increases. And as the earnings of the property increases, that increases the value of the property, because the earnings get capitalized into a price. You can never go and buy a property like a residential unit or apartment or a house that has a 20% yield. So prices of the rents rise first, it increases the rental yield, that then draws investors or draws people to then want to buy property because it has a good strong rental yield. That then pushes the demand and up, and then pushes the prices up. So then the yields get compressed, and then prices rise. So rents rise first, and then prices follow. So it's a good leading indicator to see that if rents are rising, then the following year prices will then follow as well. So Sydney and Melbourne are starting to really, the rents are starting to really rise. So in the next coming years, they will transition as um, they have been stagnant for a couple of years. They'll then start to kick into gear in the later half of this 18-year land cycle, and as we roll into the next 18-year land cycle, which will then divert from Brisbane, Perth, and Adelaide that are now leading the charge in terms of growth. They'll then top out and then stagnate for a good 10 years, and then Sydney and Melbourne will then start leading the charge in terms of the next growth cycle. So if you are still hanging around, just a bit of a disclaimer, by no means this is not financial advice. I am not a financial advisor. I operate as a buyer's agent though. If this resonates with you, happy to have a chat. We'll put my details in the comments below. If you would like any assistance buying an investment grade property, hit me up. We can have a chat about your goals and our services, and we can go from there. Um, I can guarantee one thing though, if you don't take action, you won't get anywhere with the amount of net migration and the prices rising. This is, I believe, personally, the biggest opportunity and wealth creation event seen in history that was not seen since early or the mid 2000s prior to the GFC in 2007, 2008. So great opportunity ahead as long as you understand the markets and know where to best play. Um, Hit me up any time of the week to discuss anything further. So if you're still hanging around, I have got some more data to explain a little bit more of how I see the market playing out. So the cash rate, the RBA cash rate. People asking me, where do I see the cash rate going? Personally, I think there's still more room or more petrol left in the tank for the cash rate to keep rising. I don't see it, cash rate getting dropped this year, and I don't see it getting dropped until the market tops out in 2026. I'll show you. So I'll show you why. If we go back to the 18-year land cycle, so between 2002 to 2007, we had a bull run, which was the land boom from the prior cycle. So we're in the midst of that same period in the cycle in 2024. So in 2004 is where we equivalently are today. If we go back to the cash rate graph, between 2002 to 2008, interest rates went up for a period. So we are now in the equivalent of say 2004, so 5.25% in 2004. So we're flatlining now. It's giving people more confidence that we are supposedly reached the peak, but I don't believe we've reached peak. I think we're going to probably be flat for the most of this year, and then next year and the year after, um, they're going to be jacking rates up again until the market tops out in 2026, 2027. And if Trump comes back in, then it's going to push it even higher and further. Um, so even potentially higher. So, and then once we go through the next driven downturn, like happened in the GFC, they'll drop it right back down again, probably to near zero again. So I think there's still a lot more growth in the cash rate to come. Hence why I am personally refinancing, cashing up, making sure you got good cash buffers to be able to sail through the next few years of high interest rates. If you are sailing by the seat of your pants, that is high risk. You need cash in the bank if you're carrying debt. That is the number one way to keep in the game, is to have firstly, a high cash flow from the property rental income, but also a good healthy cash buffers to keep you sailing through the higher interest rate environment that is still yet to come. Why I also think the cash rate is still got more room to go higher is based off inflation. The RBA is trying to bring inflation back down. They're doing a reasonable job of that, down to 4.1%. But based on history, if you look at between where we are in 2004, so 2004, and then in 2005, which would be like next year, 2025, it rose again. And 2006, it dropped back. And then in 2007, 8, it rose up again. So I wouldn't be surprised at all if, yes, inflation's coming down, but I wouldn't be surprised if it ticks up again to, 4.5%, 5%. So it it is trending down, but I don't believe it's just going to be a straight, smooth landing. I think it's going to creep up again based off all the overseas migration, the lack of supply of new housing. Prices are going to keep rising. That's going to all fuel into inflation. Now that the interest rates are rising as well, commercial banks are earning a higher profit margin, so they can start taking on more risk by way of lending more to people. And they'll always, in the second half of the cycle, they find there's ways that commercial banks find loopholes or new creative ways to start lending to keep expanding their loan book. So I wouldn't even be surprised if people can start borrowing money against their cryptocurrency and using that to even as security to go and buy property. So that's going to keep fueling demand and fueling credit and fueling inflation to keep pushing the cycle even higher than the last land market peak in 2007, 8. So yes, inflation's coming down, but I wouldn't be surprised if it ticks up. And if it ticks up, interest rates are definitely not going to come down. Money supply. Um, Check out Milton Freeman. Quite interesting. Um, he believes, and I can also see it too, that um, people don't create inflation, governments do. So inflation is the devaluation of the currency, where the Reserve Bank prints money and issues it to commercial banks, so Commonwealth Bank, Westpac, to then lend out at a fixed or at the interest rate or at the cash rate, so the banks then put on their margin. So prior to COVID, it was 11 billion, and then since COVID hit, they pumped all this money into the system to keep the economy kicking along, as they believe that we were going to drop into a serious depression or recession during COVID. And it's like a shot of adrenaline. Once you start hitting the economy with more money supply, it's very hard to ever back off. So that's why all this inflation that is just kicked out of left field, supposedly, is actually being caused by the Reserve Bank right in the start, as they cut a check for over 180, 190 billion dollars to the banks at 0.01%, 3 years fixed rates, lent it out during 2020, 2021. That's when Manny's dog started buying up like crazy. Market took off. They're now trying to pull it, rein it back in. But because they did that on top of a already strong economy, we were in the mid-cycle slowdown. The market just was cooling off. It didn't need that much stimulus. It's like having a car on the freeway and then backing off to 80 k's and then flatlining it and putting the accelerator flat to the floor. It's just we are pumping the economy even though we didn't need to. We just needed to keep cruising along in cruise control, but we are throttling it, which is quite spectacular to see, because you can really see the next coming years inflation continue to keep rising. That's going to get all soaked up by land value. rates are going to keep rising, and people who are over leveraged and can't maintain their mortgage repayments are going to get wiped out. Like what happened in 2008, like what happened in 1991, like what happened in 1972 and 1955, 1933, Great Depression, after the Roaring Twenties, every 18 years on average. History doesn't repeat, but it surely rhymes. Another thing that gives me confidence that the market is still on the run is the unemployment rate, which this will then also fuel back into inflation. Unemployment rate has now dropped back down to 3.7. Strong economy. The strongest economy we've seen since the 70s. So this is the max. So everyone who wants a job can get a job. You can get a second job. You can create a side hustle. There is lots of opportunity to create work out there and create business. There's lots of growing domestic demand. People want to come and live in Australia. There's lots of work. 3.1%. So it's even off the chart. You have to go back to 1975 or early 70s to get uh, this low. So it's very strong economy, which will all ultimately filter down to fueling higher inflation, and they'll all get soaked up by higher land and or property prices. Another leading indicator I like to watch is also copper, Dr. Copper, they say. So when copper starts rising, which it is now, it's not at all-time highs, but it's on the run, is means that the global economy is starting to open up and kick back into gear after a slowdown, as copper goes into everything from new construction, development, um, manufacturing. So when copper starts rising, it's another leading indicator that the economy is going to keep growing for the coming years. So copper's also good one I like to watch. So that's moving in positive territory as well. Anyway, I hope you all enjoyed a bit of an update on the markets ahead. As always, this is not financial advice, but if you are looking for assistance to buy an investment grade property, hit me up. Happy to chat any day of the week. Have a good rest of your day.